chairing the East Bay Economic Development Alliance. I want to say thank you very much for joining us today on our 2020 spring membership meeting. Before I begin, I do want to say I hope that all is well at this point in time. I know that these are unusual times for all of us, and I know as we've been staying in place and making sure we keep our social distancing and reading the newspapers, there's a little bit of anxiety that's going on, but I'm hoping that each and every one of you and your family and friends are all doing well during this pandemic. We're glad that you're able to join us today and to learn about our organization if you don't know anything about it, or to simply get updated and hear the most timely presentation about the economic indicators and the trends from the renowned Dr. Christopher Thornberg, who we've been privileged to have for several years to give us the economic updates in Overcast in terms of what's happening around the world, the nation, and also here in Alameda County. We also are going to be joined this morning by the Executive Director of the Port of Oakland, Danny Wan. We want to say thank you very much because we know these are very busy times over at the Port of Oakland, especially with the Maritime Division of the Port of Oakland, as well as the aviation port of the Port of Oakland. And so thank you to both of you for being our special guest. Earlier this month, East Bay EDA completed its East Bay Business Recovery Survey. Over 2,000 of you responded to that to get a sense of what was going on, how the pandemic was impacting or is impacting your business, how you're dealing with the shelter in place. More than 2,000 of you responded to this survey, which was very timely and has given us some insight. Slightly more than half of all of our businesses based on the survey, your response to us. More than half of all the businesses expected to lose more than 60% of their revenue over the next 3 months. And nearly 1/3 of you stated that you estimated that you would either close if we continued to have this shelter in place taking place, if it extended another couple of months or so, and the impact to you and your ability to operate your businesses. While we don't have a lot of time to get into the results from the survey today, it did paint a pretty dark and stark moment that we're currently now living in. But we're going to get this economic overview today from Dr. Christopher Thornberg, give us some insight about that. And I want to say a big thank you to the Bank of America, our major host, for hosting today's membership meeting. In order for us to be able to do our good work, our outlooks and our reports each year, to do all of the work that we do, we depend upon the generous support that we get from a number of our corporate businesses that allow us to do that work. So I do also want to thank the Workforce Development Board of Alameda County, as well as the Workforce Development Board of Contra Costa County, and of course, again, Bank of America for their support in the development of this report. East Bay EDA has over 150 members, which are comprised of business, government, special districts, environment, education, research, labor, the philanthropic community, the nonprofit organizations, all sit at a common table and help us to figure out how we can still make the East Bay the best place to live, work, and do business. And so I do want to thank all of you who've been very active in East Bay EDA, those who chair and serve on a number of our committees that specialize in your area of expertise and help us to figure out how the puzzle fits together here in the East Bay to make sure that we thrive and continue to grow. Although we've had to postpone the East Bay Innovation Award, it's generated publication that has now been shown and is now being shown in the San Francisco Business Times. So I hope that you have had an opportunity to get a sense of our Innovation Award, our awardees. We normally host this over at the Fox Theater. It's a sellout event, almost like the Academy Awards of Business and Innovation. And so copies of those are still available on the website. And I do want to say that you should go on the website and get a sense of the finalists that participated in this year's Innovations Award. Our special media channels let people know about our exciting things that are happening here in the East Bay. And East Bay EDA is sitting at all of the tables helping to kind of look at where things are now. Our members are engaged in trying to make sure that all of the operations that are reflected in our membership in particular are as strong as they can be with the cross-sharing of information that we have. Now I'm going to turn the meeting over to one of our vice presidents, our vice chair, Ed Dabacaro, who will introduce and moderate today's presentation and discussion. Again, I want to thank everyone for joining us and being with us today, and I do look forward to an informed panel discussion.
No, unfortunately, we don't seem to have Ed.
Ed unmuted himself?
No, Ed's been having some connectivity problems. Maybe we can come back to Ed.
We can come back to Ed, and I'll say that Dr. Christopher Thornberg, who's always been one to give us the economic update for East Bay EDA for a long time, is known to people not only here in the East Bay but across the country. He's been special economic advisor to a number of administrations, our government administrations in Sacramento, as well as serving on a number of important economic panels. And so we're very pleased and happy to have Dr. Christopher Thornberg with us today.
Thank you, Supervisor Carson. It's a pleasure to be with you here again. Hopefully my slides are being shown right now. Interesting times, to say the least. And I tell you, Keith said a few years. I should point out that we've been doing this for over a decade and a half. And I can tell you how much I miss actually coming up to the region this year. Now, I've gotten pretty good at the Zoom system, as the case may be, but of course it's not the same. And to be clear, over the last few years, I almost feel like I've been just going up and kind of repeating myself. And candidly, at the start of this year, I was pretty much going to be doing the same thing. In fact, I would almost call this year's talk at the start of the year a little bit of a victory tour. When I was up there last year, the U.S. was in the grip of yet another miserablest rage. 50% or 75% of economists who contribute to the Wall Street Journal at the end of 2019 were talking about a recession the next year to a year and a half. And what's funny is, as I've been saying all along, look, there's no sign of a recession, no sign of an impending downturn. The economy is actually fundamentally very good. And we got the February next recession survey, and all those bearish predictions have gone away. Only 10% of these forecasters that said we were going to have a recession this particular year. But then over there in the lower left-hand corner of that final screen, there's that little blurb. The top risk, this virus thing. Now, this was in February of last year, or this year rather. And I'll tell you that it's interesting because we were still trying to figure out what it meant, what was going on. And as it turns out, the virus is already here. People were already dying of it. And this thing really did come out of left field, and it has thrown everything into a tizzy. And while typically I go up there and I spend a lot of time talking about the East Bay, clearly the bigger question on everybody's mind is this virus thing. What does it mean for the economy? What does it mean for the rest of the year? So on and so forth. Now, I'm not going to bore you with the details of the virus itself. If you're like me, you almost can't turn on the news right now, because every time you turn on the news, 100%, all the time, story after story after story after story, is a constant retelling of the issues with the virus. Over 5 million people affected, 300,000 deaths plus globally. Here in the United States, we're rapidly approaching 100,000, unprecedented public health actions across the globe, millions of people basically prevented from going to work in an effort to combat this virus. The question in everybody's mind is, how bad is this for the economy? How long is the road to recovery? Now, we don't have a lot of data yet. I mean, we don't. We have little dribs and drabs of stuff coming in. We're just getting a few numbers for April. We got our Q1 GDP, and it came in at about negative 4.8%, which really isn't all that bad relative to the scale of things. But then again, it's worth remembering the shutdowns were only taking place during the last couple weeks of the month. It doesn't give us a lot of information just yet. The real question, again, is not what's happening right now. We know it's bad. The real question, the real debate is, of course, how long of a recovery? And if you look at the headlines, most folks, of course, are talking about a very, very painful long recovery. In fact, in some cases, they're predicting this to be a significantly worse recession than what happened during the Great Recession a decade ago. And here's some of the headlines you see out there. U.S. economic recovery could take 4 years. Carl Icahn says commercial real estate is going to blow up. The financial markets are all over the place. The IMF says this is the worst downturn for the globe since the Great Depression. 40% GDP declines in the second quarter of the year being predicted by J.P. Morgan. Here's a couple other forecasts for people that out there. On the left-hand side is the Bank of America, Morgan Stanley forecast. Just one example. I'm not picking on them in particular, but you know, these are grim numbers. They're talking about from the fourth quarter of last year to the second quarter of this year, an almost 11% decline in real GDP. To put that in context, during the course of the Great Recession, the overall economy contracted by about 6%. So this is really bad. And the same thing for UBS and their forecast for unemployment. Double digits throughout the rest of the year, and unemployment getting back to normal levels to the end of 2022. Yet again, really grim tidings. And of course, our governor has bought in. If you've been paying attention to his budget that's come out recently, he's talking about a $54 billion budget deficit. And he is already proposing just slashing budgets for all sorts of things. And his quotes, it's going to take longer than I think people think. We've never experienced anything. Depression era numbers, right? Depression era numbers. Wow. Now, to be clear, before you get wrapped up in this too much, before you let this stuff get into your head, let's also remember that when I was there last year, again, I was pushing back on all the negative rhetoric we heard in 2019. Remember in January of last year when the markets were down 20%? Do you remember why all these economists were predicting a recession? By the way, it was because, you know, real estate was already in the midst of a major collapse. And oh, by the way, the Chinese trade war was going to demolish U.S. manufacturing base. And of course, inflation was heating up, interest rates were on the rise, and clearly the U.S. economy is going to collapse into a downturn. In other words, the lesson here is very clear. When it comes to any conversations about the economy, hysteria is the new normal. So everybody always takes the worst case scenario and makes it even worse. Now, I'm not saying that what's happening now is insignificant and people's worries aren't at some level justified. Of course they are. This is by far and away the biggest negative hit to the economy in at least a decade. Yes, we are in the midst of a recession right now, but the hyperbolic negativity has simply increased proportionately. And that's what you're seeing out there. You know, for all the people screaming end of the world, here's the reality of things. We don't really know. And the reason I say that is because as a forecaster, we use the past to predict the future. And we have to use the recent past because that's when the economy was more similar and the data is relatively good. So we're always, if you will, looking for metaphors from the recent past to help explain what's happening right now. Well, here's the problem. We don't have a metaphor. The kind of shock hitting our system right now is completely different than what happened during the Great Recession. And as such, the lessons we learned back then are not applicable to what's going on right now. Now, the point here, of course, is any economist, any forecaster has to come at this with a high degree of humility. And these forecasters, these sky is falling predictions, are not acknowledging that level of humility. You know, look, we all have to take a step back and appreciate that this is different. And, I like to say this. This is an old expression I really enjoyed. It's so applicable. Good forecaster is not smarter than everybody else. They merely have their ignorance better organized. And really, in a lot of ways, what I want to do over the next few minutes while I'm here with you is to organize our ignorance a little better and see what kind of results we actually come up with. Now, to be clear, remember, why did we have a Great Recession? This is something I've talked about for years up in the East Bay, but let's do a little refresher. The Great Recession did not just appear out of nowhere. Rather, it was the consequence of the massive subprime bubble that had inflicted the economy over the preceding 6 years. From 2001 to 2007, $15 trillion of subprime credit flooded the US economy, driven, of course, by the greatest financial fraud in the history of the globe. And that, of course, has to do with the asset-backed security model that Wall Street suggested could take junk debt and turn it into gold-plated debt securities. We know now, of course, it was nothing more than a massive Ponzi scheme. And of course, we know that particularly looking at all the pain we went through back then. But the reason we had the Great Recession wasn't that money by itself. Rather, is what that money did in terms of the economy. $15 trillion being poured into the American households created massive imbalances within our economy. It caused parts of our economy to grow levels that candidly were not sustainable. Housing is first and foremost on that. We all remember the housing situation. Massive increases in prices, everybody borrowing like crazy to get in on that never-ending money train. You, of course, saw not just the increase in prices and the increase in debt, but also, of course, the massive overproduction of housing across the United States. And it wasn't just housing. Remember, people got this idea that homes always go up 12% per year and money is basically free. And people started to overspend. We saw savings rates drop to record low levels, even as the US economy opened up a massive trade deficit. In other words, in 2006, while the economy felt good, the reality was it was not good. It was an incredibly a rotten base, and it was only a function of time till everything blew up. And by the way, that blowing up started to occur in late 06 and early 07, when the housing market plateaued, when the debt market started showing the signs of strain from all that junk debt in the system. Eventually, those issues became larger and larger until everything fell apart, and we were thrust into the Great Recession in December of 2007. It was a 6-quarter recession, 6% decline in real GDP. And it wasn't just that time. It took us years to get back to normal levels of output, to normal levels of employment. Now, to be clear, the fact that this was the worst recession since the Great Recession should have been obvious because of the driving forces. In fact, a wonderful book was written in 2010 with the Great Recession right there in the rearview mirror by Reinhardt and Rogoff, brilliant macroeconomists in a field that has very few of them. And these guys pointed out a couple things. This book goes through the history of financial bubbles. But the important thing here is not the financial bubbles, but the consequences of financial bubbles. They note time after time after time that the worst recessions, the recessions that are last longest, that have the deepest amount of downturn, and by the way, take the longest to recover from, are almost always recessions that begin after a major financial bubble. And that's true of the Great Depression as well as the Great Recession, and so on and so forth. And that already tells us that maybe things aren't quite the same as back then, because we don't have a financial bubble right now. What we have is a public health mandated driven downturn. Now, I understand why it's easy to leap to the conclusion that this is really bad. I mean, you look at the numbers. We saw nothing like what's going on in the labor markets back in the Great Recession. We've already seen amount of employment in the US decline by, of course, over 20 million people. I mean, during the Great Recession, the entire top to bottom was only about 9 million, and that occurred over a couple of years, not a couple months. Scary numbers. And of course, if you look at the unemployment rate, in April, it was already up to 15%. If you look at initial claims for unemployment, they suggest continuing claims, unemployment's getting close to 17% right now. We've never seen numbers like this before. Yeah, really scary stuff. But take a little close look here. Look a little closer. you already see that something is a little bit different. If you look at what happened back in the day, with unemployment, look when unemployment peaked during the Great Recession. It peaked after the Great Recession. By the way, it also peaked after the tech downturn ended in the end of 2001, and after the 1990s downturn ended in 1990. You know, employment has always been a lagging indicator, and that's because businesses lay people off as a last resort only. It's expensive to lay people off. It's expensive because you're throwing away people who've built their careers around your company. You have to pay all that money for unemployment and severance. And let's not remember the damage it does to morale. You don't lay people off until you absolutely have to. It's the last thing you do. This time, it's number one. It's leading the downturn. It's not the effect, but it's the cause. It's completely different. And go the next step on that. How many times have you heard a reporter say, 21 million jobs have been lost? Lost is a strong word. You know, of the 17 million people who unemployment, number of people unemployed in the United States in April 2019 was 5.4 million. This year, it's a little over 17.4 million. Of that increase in unemployed people, 17 million, every one of these people have declared themselves as being on temporary layoff. In other words, these aren't lost jobs in any traditional sense. A lost job is a job that you will never get back. These people are like, hey, I know exactly where I work. The only problem is there's a public health official between me and my employer. And as soon as that public health official goes away, I expect to go back to work. It's a completely different kind of cycle. We've never seen so many people declare themselves as being on temporary layoff. 80%. During the Great Recession, it was 10%. So no, this isn't the same sort of thing. It's not a traditional business cycle. The lessons of the Great Recession do not apply, period. The shock we're seeing today is the shock driven by public health mandates. Now, a shock that creates recessions are shocks that are large. This is large. The collapse of the subprime bubble was large. Rapid. Collapse of the subprime bubble was pretty rapid. And of course, right now, these public health mandates came out of left field. Very rapid. But the big difference, sustained. Shocks that create bad recessions are rapid, large, and sustained. When the subprime bubble collapsed, it collapsed permanently. The housing market collapsed permanently. Consumer finance collapsed permanently. Millions of jobs in construction, finance, and real estate were lost permanently. This time around, millions and millions of people are on furlough. There's no reason to think any of these job losses are permanent because after all these companies were hiring these people and making money and doing okay prior to the public health mandates. Now look, I'm not suggesting this entire circumstance is nothing more than an 8-week unpaid vacation. Clearly, damage is occurring in our economy. And the more damage that occurs, the more people are hurt, the slower the pace of recovery. But the key here is that damage is not being reflected in terms of those unemployment numbers because of those employment numbers. Those are the cause of the damage. The amount of damage is yet to be determined. We just don't know. And that's the key. I know some of these people won't go back to work, but how many? That's still up in the air. If it's not many, you're right. It's a Great Recession type scenario. A big U, the Nike swoosh, whatever you want to call it. Really tough times for the U.S., for the East Bay. It doesn't have to be like that. If it's not a lot of damage, then it's a 1990 downturn. A big down followed by a really rapid up till we get back to normal levels. Or if there's very little damage in the meantime, it might look like a natural disaster. Think about Hurricane Andrew slamming into the Miami-Dade area, or the massive floods in Houston. When these things happen, for multiple months, these economies are shut down. But then once they get cleaned up and things get back up and running, people go out and do everything they were going to do, but weren't able to. In this case, you can only get a rapid bounce back, but in a lot of ways, the bounce back more or less makes up for what wasn't done during the natural recession, during the natural disaster itself. The point here is all three of these scenarios are potential outcomes. We just don't know. But we can think about what might determine it. How much damage will occur in the economy It boils down to 5 big questions. 1, how long will the shutdowns last? 2, how deep are the shutdowns? How many people are actually falling behind? 3, how healthy was the economy ahead of time? 4, what's the government doing? And 5, will there be a major shift in post-pandemic spending patterns? These 5 questions determine how much damage, thus how slow the recovery. Let's go through these quick and see where they lead us. Number 1, how long? We already know this. It's about a 3-month exercise. And we've seen this in many different ways. Now, I appreciate a lot of people keep saying, no, it's never going to end until we have a vaccine, or it's not going to end until this or that. That's not true. Look, this is manageable. We are getting ahead of it. The number of new cases is falling. We've seen places like China and Italy and Spain in front of us who've gotten in front of this. We know there's a finite level. And I know you might say, but look, the number of new cases isn't falling that rapidly. But if you look at the number of new cases, this is not a statistically consistent sample. You can't compare the number of new cases in early April to the number of new cases now. In early April, testing wasn't up and running. We had very few tests available, and the ones that were being used only in emergency rooms. Today, you can drive up to multiple parking lots and get tested on the fly. What that means is back then, we missed a lot of cases. Because remember, a lot of people get this and they aren't very sick. Some people get desperately sick, but a lot don't get sick at all. So back then, we missed a lot of new cases, where I think we capture a lot more now. The result of that means actually the number of new cases is falling quite rapidly. Our viewpoint is, look, we're already taking the bindings off the economy. We're not even halfway through this quarter. We don't expect the entire economy to open up in Q2, but most of it's going to open up. And while we appreciate that big concerts, big conferences may not go on for the rest of the year, for the most part, we look at the US economy more or less up and running by Q3. It's a 1-quarter exercise, as simple as that. Now, what about consumers? What about industrial activity? Will they catch up relatively quickly? Well, again, we look at data from China. They're ahead of us. Goldman Sachs, this is Goldman Sachs data. They have some great information. And you can see, for example, industrial activity. Took them about 3.5 months to get back to normal level. We're already seeing that happen in the United States, where we bottomed and are starting to come back up again. Same thing on the consumer side. About 4 to 4.5 months, it looks like, for China. Here in the United States, we're already starting to turn a corner and pick up just a little bit. In other words, we're already past the bottom of this. Q3, we're up and running. The question is, are there going to be people to buy anything? Are there going to be businesses to buy anything? That's the real question. And that, of course, goes back to how deep. Now, we've done any number of simulations on this, and it's really hard to get your hands wrapped around what's going on. I appreciate that the shutdowns look really dramatic. I mean, after all, you get out the highways, there's nobody on them. It's weird. Kids, of course, aren't going to school. No one's going out to restaurants. Stores are all closed. I get it. Airline, if everybody's been to the airport lately, it's weird. But this does not define economic activity. In fact, if you took all hotels, all restaurants, all airlines, all recreation, and you added them together, the amount of economic output we're talking about is about 5% of GDP. That's smaller than healthcare, which is 6% of GDP. Now, I appreciate the damage is moving beyond these frontline sectors that have been shut down because of supply chain effects. And we also know, for example, in manufacturing, auto companies have, furloughed some lines, and meatpacking companies are having some issue. But then again, remember, we've already turned the corner and industrial production is starting to pick up. We're looking for the bottom in Q2 to be something on the order of a growth rate of being between -15% and 25%. Now, to be clear, like all economists, I'm announcing that in annualized averages. This means overall, we expect about a 4 to 6% decline in real GDP between Q1 and Q2, on top of the 1.2%. So overall, about a 7% decline in GDP economic activity. Now, why is that relevant? Well, when you think about the slow recovery, the first thing that comes into your head is all the people who are falling behind, people who aren't earning income, whose businesses aren't running and they can't earn money. And because they're not earning money now, they're falling behind on their obligations, and they're not going to be able to spend a lot in Q3. That's a big negative that keeps us from growing rapidly. But remember, only 6 or 7% of the economy is actually shutting down. 90% of the economy is up and running. And even for people who may see some reduced amount of income, well, the issue for them is not the reduced income, but the fact that they're not able to spend money no matter how much money they make. The key here is for all the people falling behind, there are a whole bunch of people building pent-up demand. And the best data we got on this came from March savings rates. We have the March income numbers, and the savings rate was through the roof. Second highest ever recorded, 13.1%. What this tells us is that the decline in spending is dramatically faster than the decline in incomes. And there's an enormous buildup in savings as a result of that. There is a ton of pent-up demand. If the pent-up demand was smaller than people falling behind, savings rates should be flat or falling. This is going through the roof. Lots of money out there. And for everybody who may not be able to spend as much money in Q3 as they might like, there's other people who are gung-ho, ready to go, and they're going to spend twice as much money as they might have just because they're so frustrated being stuck at home. So yet again, this does not suggest a long-term issue. How healthy was the economy? Well, this has been a centerpiece of my talk for 5-6 years now. Yes, the economy is very, very healthy. Job growth has slowed down some, no doubt about it, but that's because unemployment was at 3.5%. Over the last couple of years, the biggest problem in the U.S. economy was the fact that there were more job openings than people looking for work, labor shortages. Now, I know you've seen a bunch of the bankruptcies, particularly some of the big retailers. We know we're not going to bring all their people back. They may not open some of their places back up again. Some people on temporary layoff are going to see that temporary layoff status turn into permanent layoff. But they're going to be re-entering a labor market that just a couple of months ago was suffering from a lack of workers. In other words, yet again, we should see some relatively rapid rebalancing. And it wasn't just the tight labor markets that give me hope. Savings rates, even before the 13.1%, had popped up. And by the way, wage gains, people have been getting ahead. The data coming out of the BLS monthly is broken. The survey has issues. The Atlanta Fed guys clean it up. The wage tracker, average real wage gains for the last 6 years, 4% per year. Median real wage gains, 2%. Good, steady numbers. Nothing wrong there. Debt problems. Prior to the Great Recession, the financial obligation ratio, the percent of household income being used for financial obligations, at a record high level. Right now, prior to the pandemic, record low level. Completely different sort of circumstances. People don't have as much to fall behind on because they haven't built up a lot of debt. And look on the left-hand side. This is data that comes from the Federal Reserve's survey of consumer finances. Yet again, you look at the share of people who spend over 40% of their income on debt obligations, the median debt obligation. Not only are people better off than they were in 07, they're better off than they were in 1998. And not only is it rich people who are better off, but actually people in every income category are better off. We actually are, financially speaking, in pretty good shape to weather this particular storm. Completely different than where we were in 2007. But you say, wait a minute, Chris, people don't even have $400 for emergencies. You know, this was done a couple of years ago in some survey, and it has this myth that Americans don't have $400 has been debunked over and over and over again. And yet it's become conventional wisdom because, after all, negative headlines sell papers, people. It's not true. People are a lot better off than this. And like, you cannot let this stuff define what's happening out there. It's just not true. It's people trying to say negative things about the economy, not having honest conversation about what's going on. Housing markets. I heard Mark Zandi come out a couple weeks ago with Moody's talking about if the shutdowns go on till June or July, 15% of Americans are going to be foreclosed on. 15%? Based on what? That's a higher share of homeowners than during the Great Recession. Now, to be clear, the number of people who lost their homes during the Great Recession was not driven by the Great Recession. It wasn't driven by high unemployment. It was driven by the fact that vast numbers of people borrow way more money than they should have to buy homes they couldn't possibly afford. That's why foreclosures were so bad back then. What about now? Is that we have a real estate bubble now? Absolutely not. Home prices have been growing at a nice, moderate 4 or 5% pace. Prior to the Great Recession, we had a record share of houses for sale for rent. Before the pandemic, a record low number. Mortgages back then, subprime defined the day. Over the last decade, some of the cleanest debt markets we've ever seen, with the median credit score above 750. We rebuilt all the equity that was lost in the great real estate meltdown. And again, we didn't rebuild it by having excessive price gains. This is just good, steady numbers. And if you really thought there was going to be a massive problem in the financial system, it should already be apparent. The problems in the financial markets back before the Great Recession didn't start during the Great Recession. They started before it. Look at data, for example, on HELOCs delinquencies, which started rising in 2006 through 2008. And then, of course, yes, they became far more acute during the Great Recession, but the problems were already apparent. Same thing in terms of mortgages and credit cards and auto loans. We already had problems in debt markets. This time around, HELOC, record low level. Mortgage, record low level. No signs of problems at all. This is not a fragile financial market. It's just not. Even on the private sector side, on the commercial side, you probably heard over and over in the last couple of years how corporate debt is at an all-time high level. That is true. Corporate debt is at an all-time high level. As a percent of GDP, it's at an all-time high level. So are corporate profits. They are also near an all-time high level as a percent of GDP. And with low interest rates, the debt burdens on American corporations are actually significantly lower than they were 20 years ago. No, this is not a crisis. And not unlike for housing, look at commercial debt, look commercial bank delinquencies. Commercial debt looks fantastic. No signs of trouble here whatsoever. You might be worried about supply chain troubles. I know we're going to have a great presentation on the Port of Oakland. I'm looking forward to seeing that. But yet again, let's be clear. We already were dealing with some of these issues because of the Chinese trade war. And what we learned through the Chinese trade war is overall the U.S. economy isn't all that dependent on global supply chains. And a lot of folks have already had training on this. You got to have inventories. You got to have multiple suppliers. These lessons are going to pan out very well for them as we work our way through the next few commodity months of chaos. Now, again, I'm not saying this is harmless, but the idea that this is going to create a depression type scenario, it just flies in the face of logic. Even the conversations around oil, everybody's all worried about the collapse in oil prices. Remember those negative $40 a barrel prices we saw a few weeks ago? By the way, the numbers were so dramatically negative, not because of the pandemic, but because we already had a massive global glut. And by the way, over the last couple of years, the biggest problem in the U.S. economy has been the fact that we've seen a collapse in oil exploration because prices are too low. Now, everybody's all worried. What does the further collapse of prices mean for the U.S. oil industry? The answer is nothing, because you can't kill a dead person. Doesn't matter. It's just not relevant. And by the way, cheap oil is good for consumers. So, government, what are they doing? What haven't they done? Go back to what happened in the run-up to the Great Recession. For the first 6 months of 2008, economists didn't even believe we had a recession. I was actively debating people on stage whether or not we were in a downturn. By the time it became apparent that things were going south fast, we had a massive stock market blow up and some of the big failures on Wall Street in August and September of that year. Well, then Congress started getting into play, but we were in the run-up to a contentious election, and lo and behold, while we got some efforts put into place, not much prior to the election, Barack Obama won. And of course, as you know, the first thing Mitch McConnell said after that election was the first thing we have to do is work with this new president to help the economy get through this tough time. Well, that was a joke. Actually, what he said was, Barack Obama, my top priority is to make sure he's a one-term president. And he went out of his way to hamstring any kind of major congressional actions. And it worked. We had too little effort, too late, and it didn't do all that much for the economy. This time around, we're a little earlier. No one's debating severity of this. And as a result of that, Congress, the Senate, the president are falling over themselves to spend money. $2.7 to $2.8 trillion already in stimulus. They're talking about more. And I'll tell you, some of the stuff is good. Expanding the number of people getting unemployment, expanding unemployment benefits. If you make $45,000 a year, right now, before at your job, right now you're making more money on unemployment. That's right. So you're actually earning more money on unemployment than you did before when you had a job paying you $45,000 a year. This is good stuff. It's going to help people bridge the gap between here and there, as the case may be. Money, those PPP loans that went to businesses that were stressed, love it. Good stuff. Subsidies for local governments, transit systems, hospitals, airports, great, love it. Giving every American $1,200, you're buying an election, not helping the economy. letting law firms and multi-global corporations get PPP loans, you're buying the election. You're not being smart about this. It's a giveaway. It is frustrating. But then again, if you're talking about $3 trillion in stimulus in a quarter where we're only expecting $5.5 trillion in stimulus, yeah, that's about a Dr. Frankenstein type, Dr. Frankenstein type jolt, electricity jolt. That'll bring any monster to life again. Again, vastly, almost too much stimulus at this point in time. And of course, it's not just the federal government, state government's getting involved, the Federal Reserve's involved with quantitative easing. IRS says you don't have to pay your taxes. Local governments, moratoriums on evictions. Large landlords are providing more deferrals on rent. Large public mortgage holders and private mortgage holders giving people deferral on their mortgage payments. It goes on and on. Lots and lots of help. All this will help get households from here to there. We're doing lots. Of course, last but not least, and by the way, I should point out, this is not free money. Boy, we only care about the next 6 months, right? Nobody cares about the kids. Nobody cares about the fact that we're going to end up borrowing $3 trillion plus this year. Look, we were already going to borrow $1 trillion in the 11th year of expansion in a fundamentally healthy economy. All by itself, that's broken. But now we're going to spend another 2 to 3 trillion more. Unbelievable. We had $50,000 in debt prior to this for every person on the planet and the country. And we're going to borrow $11,000 to $12,000 more this year. It's crazy. We have to take a step back, stop thinking about the right now, and recognize we are hurtling towards a fiscal crisis that we know is out there. We're accelerating towards it. To me, it's really frustrating. Last but not least, the new normal argument. Well, things aren't going to get back to normal because everybody's going to be afraid to go out. No one's going to go to restaurants or ball games ever again. Yet again, does that make sense, people? Are pandemics really a new normal? As far as I know, epidemics, pandemics have been with us since the dawn of civilization. Small polio, smallpox, the plague, Spanish flu, diphtheria, MERS, SARS, Ebola. I can go through a litany of things that have happened in the past. And by the way, there's no evidence in any of these past pandemics that when the pandemic went away, people started living in caves out of fear. It didn't happen that way. Shakespeare wrote some of his most famous plays while he was holed up in his house avoiding the plague. And then as soon as the plague went away, he went out, reopened the Globe Theater. Everybody showed up to watch Shakespeare's brand new play. We're going to get through this, people. People aren't that terrified. Some folks may be a little nervous, and they probably should be. But a lot more people are raring to go, and they don't care all that much. So how long? 3 months. How deep? 10% of the economy. How healthy? Vary. What has the government done? Too much. Will there be a major shift in spending? No. You add it up, this isn't a U, it's a V. It's a V. Simple as that. Now, why everybody leaps to the conclusion of U? Again, hysteria is the new normal. Take a step back, it's not that big of a deal. It's tough, I'm not arguing that. This is a recession. It'll be the deepest but shortest recession we've ever seen. Simple as that. Now, why are the markets freaking out? That's the same question I've been asking for the last decade. You know, markets were at a record high at the end of 2018. They were down 20% by January 2019. They were at a record high again by April of that year. And at January of this year, we had the third highest P ratio in the history of the United States. Third highest. It was a bubble. Now it's collapsed and it's way, way down. Look, the problem in financial markets is pretty clear, and it's been clear for a while. They're out of control. Financial markets are supposed to be the shock absorber of the U.S. economy. They're not. They've become the shock expander. And by the way, they make billions of dollars on the way up, and they're the first guys in line with their hands out when things are on the way down. Nice job if you can get it, but that's not what it's supposed to be about. You take the risk to make the money, and when the risk pays off bad, you take the hit. So, Mr. Billionaire, take your hit, move on. You shouldn't be getting bailed out by the Federal Reserve. Sorry about that. Little side note. Moving on. Where are we in California? Same thing we talked about last year. The economy has been fantastic. Yes, job growth has been slowing down, but that's a labor availability problem. Share of national personal income never been higher. Output growing faster than the nation overall. The biggest issue we face, like the U.S., has been labor supply constraints. Labor supply over the last decade in California has been growing a measly 0.7%. You can't maintain a 2%, 2.5% job growth when your labor force isn't even growing 1%. Why aren't we seeing labor force growth? Because we don't have housing growth. The number of new housing permits has been woefully inadequate. And as a result of that, people are having to move out of the state. And this is a supply crisis. We've talked about this. It's the same slide I used last year. Whether you're talking about overcrowded housing, whether you're about housing vacancies, housing units per capita, everything suggests California is massively short of housing units. We need to build, build, build. And by the way, a lot of folks are saying, oh, the reason the virus is so bad here is because of density. Actually, the virus got so bad here because of overcrowded housing. It's a separate conversation completely. And by the way, it's not an affordability crisis. We've had this conversation as well. If you look at median rent as a percent of household income, it's falling. If you look at the share of housing cost burden households in every market in California, it's down. And it's down more for homeowners than it is for renters. I'm not saying that low-income families don't have a problem. They have a huge problem. But the problem here is a lack of supply. Prices today reflect the incomes of people who win the bidding war. To give more people an opportunity to get in the housing market, you have to have more housing. More. And, when you think about the strong growth in the Bay Area, particularly San Francisco, San Jose, rock stars, everyone wants to talk about tech. It's tech. Tech's driving the show. Actually, it's not. The four fastest growing economies out there has been Inland Empire, San Francisco, Fresno, and San Jose. This is not a story about tech. It's a story about housing. And while San Jose and San Francisco have not built enough housing to meet their needs, they build a lot more than they have in past cycles. And that's one of the reasons why they're the fastest growing economies in the state. The East Bay, on the other hand, hasn't been quite as good at building housing. In fact, if you go back prior to the Great Recession, most housing activity was in the East Bay with not a lot in the West Bay. And this time around, the cycle has completely shifted. The East Bay has been woefully behind on building housing, where the West Bay has been doing a lot more. And the strains on the East Bay economy have been clear, slowing down month by month. In fact, prior to the pandemic, growth rates had dropped below 1%. And of course, with the March numbers in place, we've actually seen a little bit of decline in jobs. Now, it isn't to say, again, the economy's bad. It's a labor force conversation. And you can see how the labor force in the East Bay, because of housing limitations, has not grown as fast as South Bay or San Francisco. And remember, you're still competing with the West Bay for every single housing unit that does get built. So what you have is, we've done this study not too long ago. For example, half of all housing units built in the Tri-City Valley region have gone to people who work in San Francisco and San Jose. You gotta build, build, build. That's the way out of this particular problem. Now, again, you look at the underlying numbers, things look great. Median household incomes have been rising at a really nice pace. Some of this is driven by a hot economy. Some of this is driven by a tight labor market. And a lot of this is being driven by gentrification. Yes, it's good in the aggregate, but obviously certain households just don't have an opportunity and they're being forced to move. And that's too bad, because I want a California that is a country club California, but one that's available for everybody. But again, the way to do that is not to tackle affordability, but to tackle supply. Other forms of the data, business activity, doing great in the East Bay. You see taxable sales rising in many different ways. Tech, been doing great up to this. 2019 was a record year. The San Francisco Tech Pulse was healthy. And we have some data for 2019. 2018 was an amazing year for venture capital in the East Bay. A little bit of a slowdown in 2019, but still the second highest in record. And of course, you can look at all the big verticals on the right-hand side. A non-residential real estate, good steady increases here. Well, the housing market has been doing a lot, lots of new investment in new real estate here. Man, listen, I've been in Oakland not too long ago. It's a renaissance. The things that are happening are magnificent in the core of the East Bay, along with the things happening in the peripheral regions. But who's going to work in all these new buildings? That's always been the big question. In terms of the residential market, well, prices were flat. Sales dropped in the first quarter of this particular year. But overall, the fundamentals are pretty good. Rents have steadied. Vacancy rates in the East Bay still very, very tight. But again, without a lot of new housing, overall population growth has slowed down quite a bit. And this has been the biggest issue out there. And residential permits, I'll tell you, well, the non-res side, well, the business activity side, well, the venture capital side all look great. The number of new housing permits fell in 2019 after a pretty good 2017 and 2018. And 2020 is looking like worst yet. And this is my big fear. Look, I appreciate that this virus is a scary thing and it's causing chaos in our economy right now. But again, this is a V, sharp in short, you can't lose sight of the long term. And this is what worries me more than anything else. Because what you see is the YIMBYs, the people who are pushing for supply, losing traction. And the NIMBYs are taking advantage of the chaos to push forward agendas of rent control and controls against densification and all the things that are going to make our long-run housing problems worse. We can't let this happen. Now, if we really want to get out of this, we got to have a complete change in conversation, because to meet Gavin Newsom's goal for housing, this little bit of a slowdown we see in the short run, it's so tiny relative to how many we need. You need a game-changing plan, and we haven't heard that coming out of Sacramento yet. And candidly, the current budget isn't going to help the situation much. And of course, as a result of that, the Bay Area is more and more reliant on commuting. And again, this is problematic. You see it on the highways. You see it on the stress on workers. It's a problem as simple as that. How do you want to deal with this? How do you deal with it? Incentivize cities to want housing. I won't go through this. We've talked about it in the past. When 80% of your revenues come from business and 80% of your expenses come from your residents, it's not a wonder that all cities, particularly smaller cities, want commercial. Don't give me workforce housing. Every workforce housing building is one more nail in my fiscal coffin. And one way I suggested to do that was for the state to cover the costs of infrastructure. Makes sense. Now, again, with this incredibly negative forecast, probably not going to happen, which is too bad. We're losing track of the end game. And that's maybe the worst problem. And well, I won't get into this. Now, again, if we don't build enough housing, it isn't the end of the East Bay. It isn't the end of California. Remember, it's lower skilled people moving out and higher skilled people moving in. We end up growing on the intensive margin as opposed to the extensive margin. We become Country Club California, which looks rich and happy and successful, just like the people over at the Country Club. But ask yourself a question. Why is everybody so rich and successful at the Country Club? Because low-income people aren't allowed in. And I don't want that kind of California. I want a California that's available for everybody. And again, that's supply, supply, supply. Don't lose sight of that. So let's wrap it up. I'm running out of time here. I apologize for taking a little more than I should have. Is this a great recession type scenario? No, it is not. Back then, millions of jobs in real estate, construction, finance permanently lost. Permanently. People had to rebuild lives, rebuild careers, rebuild their finances in the collapse of a massive, giant subprime financial bubble. This time around, millions of people are on temporary furlough. It's different. Back then, very little help from the government. Too little, too late. This time, too much help. Back then, financial markets pushed to the brink of insolvency because of the buildup of massive amounts of bad debt. Today, the financial markets, because of regulations, actually look pretty darn healthy. Yes, this is going to hurt. You're going to see some problems, but nothing like we experienced during the Great Recession. So you add it up. Look, Q2 going to be the worst quarter for growth ever in the history of the United States. Q3 is going to be the best quarter for growth in the history of the United States. And my expectation is unemployment is going to be back to 5%, maybe even a little below by the end of the year. Most of these people are going to go back to work really fast. Yes, moderate upticks in debt distress, stock market, who knows? No impact on real estate values. Real estate is a long-run asset, and this is absolutely a short-run phenomenon. But for me, the big issue is losing track of housing supply problems. We're often la-la land. We're letting ourselves drop the ball. Don't. Now, they said you got to be humble in the face of this. It's different. And I will tell you, as while I am positive this is a V, there are issues to keep an eye on. There could be a second round of outbreaks. Not the outbreak of this virus. I know everybody keeps talking about the second outbreak of the Spanish flu and this flu and that flu. And yet at the same time, these same folks keep telling us this isn't a flu. You're right, it's not a flu. There was no second outbreak of MERS or SARS. There just wasn't. Now, it doesn't mean that we're not going to see a second outbreak, but the kind of second outbreak that scares me is one where you have a mutated virus. It's a low probability event, but it could happen. Global situation, we're going to hear more from the ports next, and I think that's going to be an interesting conversation. What does that mean for us? Retail's restaurants. Look, not all restaurants and retail shops are going to reopen, not because of the virus, but because these sectors were already stressed in the first place. Retail suffering from the internet. Restaurants, there are too many of them, as simple as that. There's going to be some shakeout, but remember, the people who are let go are being let go into historically one of the tightest labor markets ever seen in the United States or California. Financial chaos, who knows? The Federal Reserve seems to have it under control now. How long until tourism, entertainment come back? Those are the sectors that are really going to lag this, and it may be a little slower. And for tourism-heavy parts of the economy, there's going to be a little bit of a problem there. Last but not least, one big wild card, government. And I know Keith is probably not looking at budget numbers for Alameda County and feeling real happy about them, and I understand that. It's a really bad situation. Even if it comes back relatively quickly, you got a quarter, 2 quarters of lost revenues, and in the context of budgets that are already stressed because of rising pension obligations and the rising cost of running governments in the midst of a set of rules and regulations that really prevent local governments from going out and raising revenues and candidly shoveling all the increases in economic value to the state government, who, by the way, is sitting on them, not helping local governments. This is going to be intensified by the fact that all these portfolios have been absolutely hammered. Expect pension obligations to go up in the next couple of years. It's an ugly situation. And at the federal level, well, again, $3 to $4 trillion in borrowing this year, folks. Leaving our children with that kind of legacy should be an embarrassment to everybody on this phone call. Yes, we needed government intervention, but we needed logical government intervention, not just lobbing trillions of dollars as if it's free money. It is not. So, wrapping it up, it ain't that bad, it ain't that long. Yes, work together. We have lots of good things happening. Government from the local level to the federal level to the state level are doing a lot to help people through this tough time. There's lots of pent-up demand. It's ready to go. Let's do the right things, get control of this virus, reopen the economy, and get going. Don't lose sight of the long run. Don't let the crazy voices of hyperbolic hysteria get in the head. This is the new normal. It's how people discuss the economy, but it's not right. Don't lose track of things. Be strong, be good, and with that, I will close my presentation. Thank you very much, everybody. Keith, back over to you.
Thanks very much, Chris. We've been looking forward, a number of us have been waiting to hear your thoughts and what you were going to tell us. And when you started off with, I just don't know, I said, uh-oh, we're lost here. But you know, after having a daily diet of kind of doom and gloom by way of the media, you gave us a very encouraging perspective, and maybe we got to get back focused as opposed to being distracted. So
absolutely, Keith. And by the way, when I said, yeah, we have to approach this with humility, but you've known me a long time. Does Chris Thornberg and the word humble belong together? No. Thank you.
I couldn't figure out how you even said it, but you know, let it go.
I was a little embarrassed, but you know.
Well, thank you very much. We will have some questions a little later. Our next presenter is not new to us as well. Danny Wan has actually been a public servant in one form or fashion since the 80s. He was a public school teacher in Oakland and in San Francisco. He also served on the board of directors for East Bay Municipal Utilities District, better known as East Bay MUD to most of us. He was appointed to the Oakland City Council and then ran 2 years later and served on the Oakland City Council. He's been over at the port in one way or another for more than 13 years, giving service over there, either giving counsel, legal counsel to their maritime area and or their aviation area. And so he's been over there for about 13 years. And then November 14th of 2019, he was appointed as the executive director of the Oakland Port. Want to say thank you very much, Danny, for being with us today. We look forward to the update about the Oakland Port.
Well, thank you, Supervisor Carson, and I've had a ongoing and very good relationship with you, Supervisor, and thank you for doing this forum. It's absolutely helpful for us. I think today what I'm going to do is, after Chris's presentation, do a little bit of a microeconomic discussion about one particular sector of the East Bay economy, but it is a very important sector, and sort of play out the scenario with everybody, maybe as a case study. Chris said that the economic impact of this virus pandemic is mostly focused on a small sector of the economy. And I'll tell you, the Port of Oakland probably is mostly impacted by that sector. So let me share my screen here. Nobody can see. So I think we titled the Port of Oakland, how will leading the recovery of the East Bay economy and how you can partner. I think before we start on the sort of the main presentation whole, let me do a little bit of this introduction of the port itself. The port, let's see, can anybody see this slide here? Yeah. The port, just to make everybody understand, is about 19, cover the properties of the shoreline of the city of Oakland, all the way from the seaport here to where you see the red areas is the commercial real estate. And in the blue area is what the Port of Oakland operates as the Oakland International Airport. So we are very much the fabric of both Oakland and the East Bay. And we run 3 lines of business: the airport, commercial real estate, which means mostly focused, most people think about as Jacqueline Square, but actually we do own property all along the shoreline of Oakland. And of course, the iconic cranes on the seaport is where people mostly get the first encounter visually of the port. So we're pretty visually present in the city, as well as the East Bay as you come across the Bay Bridge. But our economic footprint is also pretty big in the East Bay. We create about 84,000 jobs, either directly or indirectly, in terms of our economic activity. You can imagine on the seaport is the truckers, it is the terminal operators, there's people who do the shipping through the port, and in the airport as well. Our airport not only is a passenger airport, but as well we do cargo shipments. Both UPS and FedEx have bases there. And in terms of our income impact, it's about $5.6 billion in both total personal consumption, local consumption, that is a direct or indirect impact of the port's activities. And in terms of our state and local tax impact, we have about direct or indirect induced indirect taxes, about $698 million in generation. So we are, I would like to say, a pretty large footprint in the East Bay economy. So let's get back to what this pandemic has meant for that. First, I'd say we just recap a little bit. We are very large in terms of footprint, both in terms of activity, economics. Like I've just said, for 84,000 jobs through the East Bay. The airport flies about 13.4 million passengers, individual trips through the Oakland airport. So businesses who fly through the East Bay, we hope you do fly through Oakland International Airport, but we do service that sector. We do about $2.5 million of containers in standard measurements through the seaport. And of course, we are, through that seaport, supply the merchandise that are imported and used in the Bay Area, as well as the Nevada region. And also, we export products in terms of agriculture and in terms of many of the products that California offers to the world. Jacqueline Square, of course, the Oakland's gateway to the Bay, where you go for very nice restaurants, gourmet food, jazz concerts, show and movies. And the port, many people don't know, actually owns many of the shoreline parks, Martin Luther King Shoreline and the Middle Harbor Shoreline Parks, and all the parks around the airport are available to the public. And of course, there's always talk about Oakland Field Dreams. The Oakland A's may be also doing the development on the port's property. We've talked a lot about that recently. But here's the COVID impact. Again, I like to do maybe this example with some of the microeconomic impact of this virus to what Chris's presentation on the macro effects. The airport passenger impact is tremendous. I say it's going off a cliff. Right now, our passenger employment is at 5%, that's 0.5 of the 2019 levels. Of course, that impacts the food and beverages, concessions, rental cars, parking, and etc. So that means jobs lost. There are many workers who work at the food and beverage concessions, who work as parking operators and rental car employees. Many of those jobs are being either furloughed or laid off. The seaport volumes also face headwinds. The seaport is not feeling the impact as much. And Chris was referring to the sort of global trends. Indeed, the Port of Oakland was dealing with the trade policies prior to the pandemic. And now that the pandemic happened, the impact has been fairly interesting on the Port of Oakland itself, but globally, we're facing from shipping companies saying that they're going to cancel about 15% of the sailings in the coming month due to decreased demand for durable consumer goods, meaning people are importing less of electronics, refrigerators and such things that we tend to ship from the port to the Midwest and to the areas. The Port of Oakland is somewhat insulated from that in the sense that we are much more of a niche regional port. So we do supply the demand, the consumer demands of the Bay Area, Northern California, and Nevada and Utah areas. So we're not feeling so much of that impact. However, imports has been reduced about 6 to 7%. But the exports, and California, the Port of Oakland is unique among California ports in the sense that we are 50% import, 50% exports. Whereas Los Angeles and Long Beach, which are the biggest ports in the country, actually mostly imports. And they are feeling about 30 to 40% drop-offs in their sailing, in their volume. And that's because imports are really suffered. But nonetheless, we do operate both the airport and the seaport, as well as Jacqueline Square. And you can see the effect of the employment drop-off. It is going to be projected to be pretty dramatic. And in terms of the port's operating revenues, we're going to see kind of a cash burn, about $50 million about the next 6 months, and about $120 million over the next 16 months if things don't improve. And again, that's a pretty dramatic drop-off in terms of our revenues. And I hope Chris is right that there's pent-up demand for people to fly again. But I tell you, the airline industry is not so sure. They are saying that, number one, the impact of this virus is going to cause them to fly less passengers per plane because of the consumer sentiments of not having to be so packed into an airplane. And that's going to cause less profits or higher prices in terms of flights. And number two, they're just not so sure that people are going to come back in a way that they feel. The airline industry is really trying to figure out whether there's going to be a realignment of that industry. And of course, you know, there's some cruise ships that are also out there. We don't do cruise industry, but that industry is completely sort of dead in the waters for now. But I'm optimistic that the port, again, back to Chris's presentation about how we may have a pent-up demand, and that is what I'm counting on. Hopefully there is not a second or third wave of this virus, whether it's mutated or non-mutated form, because people are saying that if there is really another spike of this virus, then the pent-up demand may be dampened, even because people are even be more scared to fly or to buy things or to come out and visit Jacqueline Square and eat. But we think that if there is this virus, in the most optimistic scenarios, or as Chris says, most likely scenario, we are poised to be the forefront of economic recovery. The port, its main airline, Southwest Airlines, has its largest California operations at Oakland Airport, with over 2,300 employees, is one of the strongest airlines to capture leisure travel market rebound. So we are seeing some of that trend that people, the airport is now opening up slowly. And we are in the last just a week or so seeing that our passenger count has started to rise, and people do seem to be eager to travel again. The seaport is also well positioned to capture gains the exports of California agriculture and other products. And we have at the Port of Oakland the largest near dock warehousing, refrigerated storage, and transload capacities in the US. I don't know if people are aware, but we are the leading export port of United States refrigerated products, meaning frozen meats and such. And that is why the impact, if you heard, as a COVID virus infecting people working at meatpacking plants is of a concern to us. Jack London Square also offers probably the largest open air restaurant visitor saving plaza in Oakland. We think that Jack London Square can be the place where people can come back to eat and be entertained in open space and plenty of room to spread out versus some of the more tightly packed spaces elsewhere. But so that is sort of the economic analysis in terms of the ports industry. I also point out that one of the, Chris also pointed out in his presentation, one of the issues that we face in both the East Bay and of California and probably the country is that we do see growth in terms of income in the upper echelons of our economic ladder. The wealthier folks are doing much better, but it is the middle income and the lower income folks that are not growing and sharing the prosperity. I just want to point out that the Port of Oakland is probably the institution that creates the jobs that we said we do, that are good paying middle class jobs. And it would be, that was my emphasis, I can't emphasize over and over again, the port is that. And we hope that that continues. In fact, when we say that some people make more money on employment than if they're working, that is simply not true for the jobs that the Port of Oakland offers. Most people make more money than if they go on unemployment, they'll actually do make less than what they earn at the Port of Oakland jobs. Yeah, but there's plenty of competition for the port, and here's my ask of the members of EDAB. We do have, if you're talking about keeping the economy and keeping our dollars in the East Bay, we do have competition. Oakland does compete with San Francisco Airport and San Jose. And I'll tell you the bad news is that many of the airlines do consolidate their operations. American yesterday just decided to pull out of Oakland for the time being, at least, to consolidate their operation from San Francisco. The issue is here that East Bay has the largest share of the demographic population that flies compared to San Francisco and compared to San Mateo or San Jose. We have one of the largest shares of population, yet a lot of our passengers fly through San Francisco. That's lost dollars to the East Bay. So this tendency to consolidate SFO is a threat to the recovery of Oakland and our travel convenience. In terms of cargo volume shifts, we've seen that the West Coast ports have lost shares. With share from 70% in 2010 to less than 65% to the East Coast and to the South, mostly because of cost. The Port of Oakland and the West Coast ports are mostly more expensive in terms of labor and other costs than the East and South. And we have to capture the cargo that's exported from the Central Valley in Northern California, but LA and Long Beach are competing for that. So here's the ask from you. In order to help the Port of Oakland and to retain our jobs, I ask that when we policymakers and businesses advocate for planning, that we advocate for planning policies that provide for industrial goods movement, zoning, industrial residential buffers, and warehousing logistics. Remember, we're dealing with middle-class, good-paying jobs. When we plan, I understand Chris's thrust is that residential is everything, but frankly, in the East Bay, residential is not everything. If you want to preserve good jobs, we have to plan for the industrial, for the resident, for the warehousing logistics. We have to plan for industrial and residential buffers. And we have to provide for transportation corridors for regional trucking activity for overweight corridors, and for dedicated goods movement vehicles separated from bike and pedestrian traffic. That is certainly an issue that the port is facing all the time, being in the middle of an urban center, that when people plan for things, we put bike lanes, for example, on truck routes. Well, that's not going to be very helpful to sort of goods movement transportation. And lastly, I think a lot of businesses online do fly. I hope you will fly again soon if you're not flying anymore right now. I would appreciate some cross promotion. We do this cross promotion, for example, with Cal Berkeley, where we are the official airport of the Cal Athletics. We hope to do more of that cross marketing with you. There's opportunities of that and promote both Oakland and Oakland businesses in the East Bay. Please also, we ask, San Francisco does this, San Jose does this very effectively. They get their businesses to fly out of their own airports. We are asking you as well, the people who are listening on this line, to help us and contact me to an airport to adopt such fly local and fly Oak policy. That is both keeps our business in the East Bay and help us thrive. And of course, if you're in the import and export business, please designate the Port of Oakland as your port of import goods and supplies. So with that, I think the conclusion is that certainly the port is a big chunk of the East Bay economy. And as I said, good paying jobs is what we're producing. And we are, however, on the forefront of facing this pandemic impacts because we are travel, leisure, and goods consumer goods. But I think we believe that we are going to be in the forefront also if this pent-up demand can be unleashed to capture that market from the East Bay, and we ask for your help.
I want to thank you very much, Executive Director Juan, for your overview, your economic overview, being led by one of the largest employers in the East Bay, the Port of Oakland. For members who are guests who don't know, our organization was founded 30 years ago, basically to assist the Port of Oakland in its activities to dredge deeper in the channel so that it could maintain its competitive nature worldwide and nationally in the area of maritime operations. So we continue that close relationship with the Port of Oakland, and we look forward to supporting it. To our members, I want to say that there's been a few questions that have popped up in the chat room, and we want to try to give a few minutes to answer several of those questions. We might go a few minutes over time, but given the fact that this is our economic update and one of our signature events, I hope that you'll give us a few extra minutes. I'll turn it over now to the Executive Director for East Bay EDA, Stephen Bader.
Thank you, Supervisor Carson, and let's give it up to both Chris and Danny for their great presentations. Great to hear both of you and your perspectives. And I want to start off actually with a question that came in that I think really touches both of you a little bit, and it's as follows. With the restrictions that the U.S. and China are imposing on trade, what do you think about the trends of manufacturing in the U.S.? And then on a secondary and related point, what do you think about the implications of the U.S.-China trade war and what may happen relative to some of the activity that we see?
I know Danny's going to have more of an opinion on that from what I would call the logistics point of view. From my perspective, look, American manufacturers have been dealing with the trade war for a year and a half now. If you're not already in front of that, looking for new places to buy supplies, to widen out your supply base, well, then you really haven't been paying any attention. But for the most part, for those who are really worried about China and what they may or may not do, remember, when it comes to any kind of trade combat between the United States and China, the United States has the upper hand. After all, we export far less to them than they export to us. So, even the first set of tariffs were met on their part by a big devaluation of the yuan. So in a very real sense, while there may be disruptions, at the same time, that cheaper yuan has made American manufacturing a little bit more able to continue to source from China. You haven't seen that much disruption at this particular point in time. Now, it'll be interesting to see how this shakes out. Obviously, the the issues between the United States and China, between Trump, candidly, and the Chinese government are intensified by this virus. And how this shakes out, I'm not quite clear. But again, we're kind of in wait and see mode at this point in time. It's more of a policy forecast than an economic one.
On the port side, we do see that the Chinese and American trade wars, as we call it, had an impact on our supply chain. Manufacturers do see that Chinese imports have decreased. And also, even before the pandemic, the impact on the sort of supplies, sourcing, as well as our exports. Remember, California exports a lot of agricultural products that the farmers had to go source other buyers of their products both because of the U.S. restrictions, also because of the Chinese retaliations on both sides. So it had an impact. And before the pandemic happened, the agricultural community was hopeful that the last sort of phase 1 agreement between Trump and the Chinese was going to, in fact, incentivize some more purchases by China of our agricultural products. And that, of course, was then stalled by the pandemic. The Chinese then had to shut down a lot of their manufacturing capacity. That definitely had an impact on the shipping industry in terms of imports again. And just as they were opening back up the manufacturing capacity, the Americans side then shut down, and that had an impact on terms of demand. What we're seeing right now is a lot of the imported products are piling up in warehouses with nowhere to go. So the part of the problem is then you back up in terms of further imports. That's just not possible. There's no space here for storage. And the other impact is, so some of you who are sourcing supplies and also are finding new markets to export, is that the market is shifting in terms of imports from China to some of the Southeast Eastern Asian countries, such as Vietnam, such as Thailand, Taiwan, and Indonesia. The market share of imports to the United States from those countries are now starting to rise, though the problem there is that they don't currently have that capacity to really fill the gap.
Thank you from both of you for that. Want to just off that pivot to a slightly different but somewhat related topic, which is about the built environment and space, and really kind of two pieces. And this is probably mostly for you, Chris. But as companies are moving toward remote work, demand for office space is going to change, and as will other kinds of built space. And on a secondary related piece, there's been a lot of moratoriums passed, both commercial and residential. And your thoughts on what that does to the market?
You mean the moratorium on evictions? I want to be clear on the second question.
Yes, correct.
Okay, great. I appreciate that. So, yeah, I mean, look, there are a lot of lessons being learned here. And look, we already know that there were some big shifts happening in the commercial real estate industry. Take, for example, office space. Office space really hasn't seen almost any declines in vacancies across the East Bay since the Great Recession came to an end. It isn't to say that stuff isn't being built. Lots of stuff is being built. But what's happening here, it's really a shift in the kind of space people want. And as a result of that, new stuff is getting built. It's being quickly occupied, but then the old stuff, of course, is not being as used as intensively. So in a sense, this is an opportunity, I think, for local government to think about how do we repurpose that older commercial real estate that maybe isn't as desirable as the new stuff being built. And of course, you know what I think. I think they should be converting all these old buildings into apartments and various sorts of residential housing. That's what you need to do to continue to fuel the growth, amazing growth in the Bay Area economy. Now, the bigger question is will that pandemic really shift this up? And yes and no. Again, I think we're learning a couple of things here. I think most employers are learning that, yeah, maybe it's okay for people to work from home once or twice a week. And I think that's good. I think we're all recognizing that if people are able to work from home once or twice a week, you'll take pressure off the highways, you'll take pressure off these workers, you'll take pressure off the environment. That's great. We should have that. At the same time, though, I think we also realize that working from home all the time is not functional. I know myself, we have new people starting. We are lacking the camaraderie, the interactions, the intellectual stimulation that comes from an office environment. And I think our work is suffering at some level. So the lesson here is offices are never going to be passe, but then again, maybe you don't need to go to offices all the time. And under that sort of environment, yeah, I think it will intensify a little bit of that diminishment in demand for office space per office worker, as the case may be, just intensifying a trend that's already been in place for a little bit of a while. I will say a little bit of a side note on that. One place we've also learned that it doesn't work is public education, or really education in general. I have talked to folks from kindergarten to college, and students and faculty alike are incredibly frustrated in this particular environment. They're not happy. They don't find it a good educational experience. People aren't learning. It's as simple as that. And I'll tell you, our state at some level has been trying to take the cheap way out, as opposed to recognizing if you really want to get more Californians ready for the modern economy, gee, we'll just do online classes so we can expand what we offer without spending any money. Well, no, that's not going to work. If you really want to get more kids better educated, you need to make the investments in your facilities. You need to expand your community colleges. You need to have better classrooms, better labs, and all the stuff kids need. And that means, yeah, coming up some money to do it. And the state should be able to do that. I mean, the kind of money that's been pouring into the coffers, they should be able to use more of that money to invest in public education as opposed to doing all the little things they're doing. The second question there was on the moratorium on evictions. And this goes back to a broader conversation about two things. The first part is, what are those fixed costs? 'Cause a lot of people say, well, gee, look, restaurants are going to be able to reopen. Well, why not? Well, because they're falling behind. Now, when you think about it, if your restaurant's closed down for 2 months, falling behind is kind of an odd term. What are you falling behind on? You have no expenses because you're not employing anybody. You're not buying any food. The one place you see you fall behind on, of course, are fixed costs, and fixed costs primarily relate to rent. So, yeah, the moratorium on evictions, I think, was a very good thing. And I'll tell you why. Look, every landlord should know this, that you would prefer to lose a couple months of rent to having an hole in your shopping center, right? It's as simple as that. And while most of them are giving rent deferrals, reasonably speaking, ultimately there ought to be some rent forgiveness. I just think so. And that's true on the apartment side as well. I don't think income inequality is as big of a deal. And Danny, I appreciate your comments on that. I realize that that's kind of the natural inkling everybody has, is that, oh, gee, lower skill people aren't doing well. But actually, over the last 3 years in the East Bay, the greatest pace of earnings increases are for lower skilled people. Tight labor markets have truly given people who didn't have an opportunity before opportunities to get ahead in life, and that is fantastic. The real problem has been wealth inequality. Those who are rich are getting richer, more and more wealth, and those who don't have are having trouble building up that wealth. Well, here you have a classic circumstance, because I don't think this pandemic leads necessarily to a big increase in income inequality, because I do see labor markets returning rapid, but it will increase wealth inequality. And again, how do you deal with that? Well, what do most households deal with? Their biggest fixed cost is rent. Yet again, the answer here is a little bit of rent forgiveness. Now, there are two ways of going around a little bit of rent forgiveness here. One way, of course, is to simply put a moratorium on evictions and let the market deal with itself. After all, but you're giving renters a leg up. You're giving them a little more power by having some sort of constraint on evictions in the short run. And hopefully that negotiations will work right. And in the end, landowners, who for the most part can deal with a couple months of lost rent, should be the ones sucking it up and taking the hit on that. That's just my personal feeling. And by the way, I'm a guy who owns some property, so I understand the firsthand of that. And so I actually applaud that effort, as long as it's short term. Where I start getting really frustrated are long-term efforts of turning a short-run crisis into long-run policy. Look, I think most renters in the state of California deserve a couple months break, given the circumstances. If you're on unemployment, you shouldn't have to pay rent for 2 months, period. Bam. However, I am completely, utterly, totally, completely against any effort to expand rent control as a result of this. That's a long-run policy that will do tremendous long-run damage to the desire for developers to build rental properties in our state. You don't do that. We have a housing shortage. You want to work to intensify supply, not constrain supply. So let's use short-run policy to deal with short-run issues and long-run policy to do long-run issues, and then we're going to be okay. And I fear that in the context of this chaos, we're losing that particular lesson.
So Stephen, the Port of Oakland actually does do a lot of commercial and office space leasing in our commercial real estate sector. And Christopher is right. There is obviously it's smart business to sort of rent defer, to first do rent deferral for your restaurant and your for most of your restaurant business. But long term, we expect that there are restaurants, there are businesses that even before the pandemic had its issues. So to turn this into so that, you know, I don't know how much assistance you can do for businesses that were not doing well in the first place. But for those we want to keep the restaurants that are been doing good business prior to the pandemic. And we are certainly doing the deferral in the short term and seeing as we go how the situation develops. Office space as well, we do some of that. And we are going to see a trend of offices. First of all, there's this idea of open space concept where everybody works in massive common area and there's not a lot of separated office. Well, that has gone out the window for at least the time being of this, so the open space office concept. And number two, yes, we are going to see people, I think about working from home more, and office space demand we expect will change in nature of what kind of space you need. Like I said, Jack in the Square on commercial space is a very wide open air kind of concept. And we hope that is going to be a positive trend going forward.
Stephen, since we've gone over a little bit, maybe just one last question and then we need to close it out for today. Stephen.
Perfect, yeah. And just on that note, and on a couple things that you both said a moment ago, yeah, you know, sort of a few things sort of together. One is that the extent to which the pandemic goes on, you know, and Chris, you alluded to this briefly, but sort of what that does to exacerbate some of the things that we're seeing around business owners who've gone out of business or on the precipice already because they may not have been very solvent. You know, what happens to them? I mean, what's happening to some of them now, and what does that do to perpetuate some of the structural inequality that's happening that I think many people are coming to terms with in a much more profound way than maybe before?
Right. Well, again, I think we've said this over and over. There clearly, I don't think that the pandemic has a long-run impact on the economy, but it does hasten issues, stressors that are already in our economy today. Whether, again, restaurants, because we're suffering because there are too many restaurants, suffering from the minimum wage issues, suffering from labor availability, as the case may be. Same thing on the retail side. But I want everybody to pay a little bit of attention to the idea that the fact that, again, while we have to worry about those folks and make sure they get through this tough time, we have lots of systems in place to help them through that. Broadly speaking, the economy is very, very healthy. The vast majority of people are going to be able to go back to work as soon as the public health mandates get lifted. I just saw coming across my desk was an announcement that San Luis Obispo apparently is the first county in the state to reach stage 2, and restaurants will start reopening there. We're moving in a positive direction. The faster we go, the quicker we're going to get back up and running. Again, my fear here is allowing the short-run chaos, as dramatic as it is, to take us off our long-run goals. And you know, Stephen, the hard work you guys do there at the EDA to promote the East Bay and help the economy and help these businesses pursue forward, you need to keep your eye on that end game as well. You need to continue to focus on the things you do on that long-run basis. If we all drop everything to deal with the short run, when the short run goes away, we're all going to be sitting there wondering what happened to all these efforts we put so much time and effort into. Look, there's always ebbs and flows in economies. There's always winners and losers. We have to have systems in place to help those people get reintegrated. The good news is I believe they will quickly reintegrate into one of the fundamentally most healthy economies we've seen in 30 years.
I want to let actually Dr. Christopher Thornberg's words be the final words for today. It's good to have some encouragement after a diet of just doom and gloom, and we appreciate it. Yeah. And as in the past, I hope your forecasts become true going forward.
Doing pretty well so far.
Danny, I want to thank you very much for participating. We look forward to our continued collaboration and working relationship with the Port of Oakland, and we wish you well. To all of you who joined us today, you can go online and download what you just heard, or go back and revisit it and share that information with your colleagues and your friends and family. We hope and encourage that you do so. Take advantage of all the good research that East Bay EDA does on a daily basis, and I want to thank staff for all of the work that they've done. I hope that those of you who are not members of East Bay EDA, I hope you'll consider joining our organization. We're planning a number of chat events throughout the next couple of months while we're still going through transition and recovering and regrouping and rebirthing ourselves. And we hope that you'll join us as we bring on thought leaders and thoughtful individuals to bring presentations. Consider joining and being active in our organization. To our membership, I want to say thank you very much. We have a lot of work to do to roll up our sleeves to get our economy back up and running, and we hope that you'll join East Bay EDA's recovery group as we collectively leverage our best thought in terms of moving in that direction, along with our government decision makers as well. With that, I want to say thank you to everyone. Be safe. Thank you very much.
Thank you.